Goldilocks economy. You must have heard of this term. See, when the Union Budget of 2026-2027 was presented, a widely held belief was that India has entered a Goldilocks period, which means a Goldilocks economy. Now, what is Goldilocks economy or what is Goldilocks period? See, it is a phase where economic conditions are ideal, which means there is steady economic growth, there is low inflation, and there is low unemployment. Again, I repeat, steady economic growth, low inflation, and low unemployment. Now, this phrase, which was used by the RBI Governor Sanjay Malhotra, suggested that the Indian economy was a well-balanced and resilient economy. However, recent developments have challenged this optimism, triggering an important debate. That was India really in a Goldilocks phase? Was India really in a Goldilocks period? Or was the economy weaker than actually projected? See, as I've already told you, a Goldilocks economy represents an ideal economic condition where there is a balanced growth, where there is low inflation, and where there is full employment. Now, without overheating or slipping into a recession, this is also very, very important. Also, a Goldilocks period is characterized by stable interest rates and modest inflation. And a Goldilocks economy, it provides an optimal environment for investments, especially in equities, as companies experience positive growth. Now, although desirable, a Goldilocks economy is generally temporary due to inevitable business cycles. As you all know, business cycles, they go up and they come down. And maintaining it requires careful monetary and fiscal management. And government interventions such as tax adjustments, fiscal spending, they play a very crucial role in achieving a Goldilocks state. But they are not long-term solutions and can have a mixed effectiveness. Central banks like Federal Reserve, they help maintain a Goldilocks economy by regulating interest rates in the economy to balance growth rate and control inflation in the economy. But as I've told you, recently there have been challenges to India's Goldilocks position. And many experts have suggested that India is, rather than being in a Goldilocks position, contrary to that, is not in a Goldilocks position. To explain this, there have been several data which have been quoted by several experts. And to understand that, let us understand about the recent developments of India with respect to GDP and different metrics. See, first of all, GDP calculation revision with a new base year, that is 2022-2023, it revealed that earlier estimates with the base year of 2011-2012 had overestimated GDP. Also, global geopolitical instability, especially the US-Iran conflict, have raised concerns over oil prices and supply disruptions. And the Indian rupee has weakened further against the US dollar. And let me tell you, in the last 6 months, Indian rupee has performed really poor with respect to US dollar, and thus performed poorer than Pakistan's currency as well. Also, Japan and UK, they have overtaken India in the nominal GDP rankings as well, and India is currently the 6th largest economy, while earlier it was the 4th largest economy in the world. And not just this, there are rising concerns of slower growth with higher inflation, stagflationary risks which have emerged in our country. Now, because of these trends, these reasons, many experts are pointing out that India is no longer in a Goldilocks period, or India is no longer in a Goldilocks economy zone. Not just this. Earlier, there was a report by UNDP as well. See, the ongoing conflict and the military escalation in the West Asia, we all know it could have a far-reaching economic and social consequences for India. And one report suggested that this West Asia conflict could potentially push up to 2.5 million people, again I repeat, 2.5 million people into poverty and reversing some human development gains in our country. And this is suggested by none other than a report by UNDP, which says that the West Asian conflict can push 2.5 million Indians into poverty. Now, this report, which was titled as the Military Escalation in the Middle East, Human Development Impacts Across Asia and the Pacific, highlights how crisis in widening human development pressures across Asia and Pacific. Now, the report further states that in a severe scenario, India's poverty rate could increase from 23.9% to 24.2%, pushing 2.5 million people below the poverty line. And this would bring the total number of people living in poverty in India to an estimated to 354 million people, up from 351.5 million people pre-crisis. The report also warns of setbacks to the Human Development Index as well across the region, and India is projected to lose between 0.03 to 0.12 years of human development progress. Now, because of these reasons, many experts are pointing out that India is no longer in a Goldilocks position. Now, let us try to understand the growth and let us try to see the reality. First of all, in relation to nominal GDP growth of our country. See the key trends of nominal GDP, which is measured output at current prices, of course. See, compounded annual growth with respect to this nominal GDP is just above 10% from 2014 to 2026, while it is around 12.3% for 2004 to 2026 and 9.5% from 2019 to 2026. Now, what do we interpret from this? India's nominal GDP growth rate have steadily slowed over time, indicating a weakened economic momentum. And which is why, not just this, we have a moderate real GDP growth as well. See, real GDP, as we all know, it removes the impact of inflation. Nominal GDP, it is the overall GDP of the country, which is at the current prices. The real GDP is at constant prices, which means real GDP neglects the impact of inflation and better reflects actual output growth. Now, the key trends are a compounded annual growth rate of above 12% since 2004, and 6.2% from 2014 to 2026 and below 5.5% from 2019 to 2026. And the interpretation is that this growth rate is modest, especially for a developing country aspiring to become a developed nation by 2047. This real GDP growth rate is less. Now, since we have understood the current scenario of the nominal and the real GDP, let us try to understand that why this Goldilocks narrative might be misleading for our country. So first, the base effect trap. A critical methodological caution, for example. See, first of all, cherry picking post-COVID years, it distorts the true picture in a real sense. Also, the sharp rebound, which we saw from 2021 to 2023, it reflected recovery from the low base of 2020 contraction. See, 2020 our GDP went really low. And if we see from that respect, the growth rate seemed really high in 2021-2022, and it is not genuinely a structural acceleration, it is just the base year effect. And citing only these figures, it creates a false Goldilocks narrative, and it misleads both the public discourse and both policy making as well. See, because simply you understand, we always calculate growth with respect to the previous year. Now, if we see that the previous year is okay, this year it is a little bit better than okay, so growth rate will be 2 to 3%. But if we see the last year, there was a contraction. GDP was in minus percentage, GDP growth rate. And the next year, even if it is +1, +2, we'll see the overall number being really high because of the base year effect. And this might be misleading, which is why this is one reason why there is a question to the Goldilocks discourse. Also, the growth inadequacy for developed nation status. That is another point. See, a real GDP growth rate of barely 5.5% over 7 years is insufficient for India to achieve Viksit Bharat, or developed country, by 2047. And economists, they broadly agree that India needs a sustained 8 to 9% real growth annually, 8 to 9% real growth annually for such a transformation for India to become a developed economy. That is another reason. The third is weak corporate earnings. See, modest GDP growth rate has directly translated into underwhelming corporate earnings in our country, reducing India's attractiveness to both domestic and foreign investors in our country. We have seen negative net FDIs, and because of that, it comes to another point of ours, weakening of Indian rupee. See, net foreign direct investments have turned negative, which means people are pulling back their investments from India rather than pushing investments to India, and it is reflecting diminished investors' confidence. And the resultant capital outflow, not inflow, capital outflow is a major structural reason for the rupee's depreciation in our country. Notably, the rupee is weakening even as the dollar itself weakens against the most global currencies. This we have not actually seen, signaling an India-specific confidence deficit. And that is another reason because of which we are challenging this Goldilocks economic phenomena. See, the GDP revision, it downgrades India's economic size as well. And the new GDP series, it has effectively shrunk India's measured economy, meaning India is a smaller economy in absolute terms than previously believed. And this is a significant setback to the narratives around India's imminent rise to the world's third largest economy. And because of this, and again, we are challenging this phenomena. Also, energy import vulnerability in the recent times. So, India's near total dependence on energy imports via the Strait of Hormuz makes it acutely vulnerable. It makes India acutely vulnerable to West Asian geopolitical instability, and it threatens both the current account and inflation management in our country. Which is why, because of these reasons which I have stated to you one by one, we can very clearly say that India's Goldilocks position or Goldilocks period is actually not very true, and we can challenge it. Then the question is, what is the solution? What is the way forward? What we should do? The first thing which we need to do is structural reforms. We need to target manufacturing competitiveness. We need to target labor markets and land acquisition, and they are urgently needed to meaningfully lift the sustainable growth rate. Second is, we improve the investment climate in the country. Now, through regulatory predictability and ease of doing business, it is very essential to reverse the negative FDI trend. And by doing so, we'll be able to solve the problem. Third is you increase energy diversification. See, accelerating the transition to renewables and diversing import sources can reduce geopolitical exposure to a very great extent. Fourth solution is be honest economic assessment. Have an honest economic assessment by the policymakers, to be done by policymakers. Avoiding base effect driven optimism is very necessary for designing credible long-term strategy for our country. And by doing this, fifth point is we need to have a transparent GDP methodology as well. Timely data revisions should be institutionalized to ensure policy decisions they rest on accurate ground realities. And by continuing with all these 5 strategies, 5 points, 5 solutions, we will be able to ensure that India comes back to its Goldilocks period, Goldilocks economic situation. See, the recent data, it suggests that India's economy may not have been in a true Goldilocks phase, but rather in a period where headline numbers, they mask the deeper structural slowdowns. But for India, it is to realize its long-term ambitions, policymakers must move beyond the celebratory narratives, and they must undertake hard reforms, hardcore reforms, structural reforms that generates jobs in our country, that leads to huge structural growth, sustained growth in our country. It brings in investment inflow in the country and brings resilience to our economy. Only then we can say that India can transition from a large economy to a genuinely prosperous economy. Only then this can be done if all the points which we have suggested are implemented, not just in letter, but in spirit. I hope you gained a new perspective from this session. Do let me know what are your views regarding this, that was India in a Goldilocks phase or not, and were you actually able to understand what is a Goldilocks economy? Do let me know in the comment section. All the very best. Have a beautiful day. Thank you, everyone.